In the last episode of the Wealth Talks podcast, we talked about what people need to know to benefit from the infinite banking concept. This time, we're talking about what it takes to get the most out of the infinite banking concept.
The most important thing people need to know to benefit from the infinite banking concept is how to get started. There are a lot of benefits of using the infinite banking concept, but you don't get any of them unless you get started.
After this episode, you will know how to expand your system of policies.
And of course, expanding the infinite banking concept doesn't necessarily mean adding another policy.
Not always.
It means managing the policy that you have to the utmost so that the expansion of policies will come naturally.
Certain points that make sense to expand your system of policies are when your income goes up. Cash flow has now changed, and you should be saving a little bit more of the new income that you're making. Another point to expand would be as you're paying back policy loans. If you've paid back the policy loans to the insurance company, but maybe you're paying them back at a higher interest rate, not all that money might fit back into the policies that you have right now. So that would be a point in time to look at perhaps starting another policy to accommodate the difference.
And that happens frequently when people follow a plan of paying back their policy loan as if they were paying back a creditor. Let's say someone's paying 23% interest on a credit card and they're only paying 5% back on a policy loan. If they pay all of the 23% back to the policy loan as if they were paying their credit card, it's not all going to fit in that first policy.
It's not.
Well, it will fit, but they'll just have taxes to pay.
Nobody wants that.
So now it's time to think about expanding your policies.
Another opportune time can be when your premium in your policy is reduced. And when we write policies, we're looking for the maximum amount of cash value in those policies. And over a period of time, that premium will reduce. And that can be a great time to say, hey, I've been paying all this for premium all these years, and now there's a chunk of this premium that I don't need to pay. It might be a great time to expand and purchase another policy with those monies.
Can you explain why the premium goes down like that?
Well, it's how we structure the policy. So there's two parts of a policy premium. There's the base that's buying most of the insurance, and then there's what we call a paid up additions rider, and it buys a little bit more insurance, but that insurance that it purchases is paid up. So because of that paid up insurance, it builds equity in the policy, and so that's what's building the cash value. I tell people it's kind of like having a mortgage, and when you get a portion of your house paid off, well, now you have equity that you can borrow. It's similar in a life insurance policy. And over time, we're going to stop paying so much that paid up additions rider, or maybe stop paying it altogether and just pay that base premium, because now the policy is going to be generating its own cash value. It's going to be doing it so quickly that it no longer needs that paid up rider on the policy. And so by taking that off, you're used to paying it anyway. Why not put it into another policy that is going to be growing in a similar way?
That's a helpful explanation. It's kind of like starting a new business. You put in a lot of effort and capital at the front end, but then as the benefits start accumulating there, you don't have to keep putting that in. When you have got a sustainable business going, then the cash flow continues with less effort than it took to get it started.
Yeah, and very similar to real estate as well. When a real estate investor purchases a property, and that's the property they purchased, but then over time it becomes profitable and they have to sink less money into that. And what do they do with the profits? Do they add on a second story? No.
Usually.
They go down the street and they purchase another property. Why? Because they can make more money with the two properties. And that's often what's happening with the life insurance policy as well. People will say, well, can I dump more money into this? Well, yeah, sometimes you can. Sometimes it's better to go take that money and purchase a second policy. And we can demonstrate that so they can see, oh yeah, this would be a good idea.
It's life itself. It's like getting on the expressway. You have to accelerate pretty fast to get on the expressway to get up with traffic speed or the interstate. But you don't keep your pedal to the metal after you get on there. You back off a little bit. I was watching Elon Musk's rocket booster come back and sit in the cradle the other day. That rocket booster's right back there ready to take off on another rocket. And that's what we're doing here. If that booster stayed on the rocket or the capsule, it would never get to outer space. And so there's a need for it to start with, that paid up rider. But then you drop it off, and the best thing to do with it is not just drop it off and waste it, but be like Elon Musk and start another policy with it.
A lot of times, too, people want to treat money differently than the things that money can buy. I remember someone telling us, would you buy a steak today and put it in the freezer for 20 years and then get it out and use it? Well, no, because it loses its value. It doesn't taste good. You've got to store it all that time. Sometimes people do the same thing with money. They think, oh, I should just get it and keep it, stick it away somewhere. Well, it loses value over time. So we want to make sure that we're not treating our money the way we wouldn't treat things that money can buy. And when I think about when we go to the grocery store and we get home, the refrigerator is full. The next day, should we go out and buy more groceries? I mean, those were great purchases. No, we got to use what we have, and there will come a time when we know when we need to go grocery shopping again, because that refrigerator will be emptying out. That's a great time to go grocery shopping. And so the same thing happens with policies. We'll get to the point where we realize, hey, we need another policy because we are managing this money and using it.
Another time to expand your policies is when you have borrowed from the policy to make an asset purchase or an investment that's generating capital for you. And as that capital comes back into your control, it's probably not going to all fit into that policy loan that you took. And so that's another it's time to start another, expand my system so that I can be earning money on the money that I'm investing at the same time.
John, the other day you were telling us about some clients that you're working with, and they have multiple policies. And now they're coming to you more facing retirement now. And you were saying that those, because they purchase multiple policies, it really gives them more options.
It sure does. Yeah, as we're looking at the numbers, it makes more sense. Having those multiple policies, they can keep one and maybe pull income from another one in a way that wouldn't be available if they just had one policy. It definitely gives them more options.
When we talk about expanding policies too, it's not always just another policy on my life. It's a policy on our insurable interests. So if I'm an employer, maybe I need to be thinking about insuring my key people in my business. If I'm a parent, maybe I need to be thinking about insuring my children so that we're fulfilling Proverbs 13:22 that says a good person leaves an inheritance not only to their children, but to their grandchildren. And so by buying policies on our children, that death benefit is going to bless our grandchildren.
You can purchase additional policies on yourself, on your spouse, on your children, on your grandchildren. In fact, it's beneficial to have multiple policies on one person's life because just like these clients I was working with for some retirement strategy, it gives them more options, by having multiple policies on each spouse's life, it gives them more options in planning for retirement income as well.
One of our clients recently watched one of our videos. His name is Ben. He bought a policy on his life. They also bought a policy on her life. And then he was watching one of our videos and it gave him an idea. He said, over the years, I've been saving money up and it's just sitting in my bank account and it's a chunk of money. Could I purchase another policy with this money? Well, it's taken several years to collect this money together. We don't want to burden him with a policy that he's going to, pay today, and then in another year, he's got to come up with these funds again. So he said, is there a way I could use this money? And we had several ideas for policy designs that would use that money over a period of years. We presented several different options, all good options, but we knew he had to feel comfortable with the option he would choose. He spent some time looking at it, And we went back into underwriting because he found one of those policies that made sense to him. He gave him access to that money, and it gives him opportunity to use that money over premiums for several years. And that was a very good option for him.
One of the ways you can expand your system of infinite banking policies is by starting more whole life insurance policies. But not always is the best time to start new whole life insurance policies. So you can also get convertible term insurance. Term insurance has a place to provide a large amount of death benefit protection for a relatively low premium, but it doesn't last forever. That can be a good thing, especially for young families when they need that additional coverage, but it also can help you expand your infinite banking system. Can you explain to us how that would work?
It's kind of like buying insurance to buy whole life insurance in the future. And what I mean by that is when you have a convertible term policy and you decide, hey, I would like another whole life insurance policy, you can convert some of that term to a whole life policy. And whatever rating you had on that policy, you get to use for your new policy. So whether it's preferred plus, preferred, standard, whatever it is, even if your health has gone south, you get to have that rating. So you still use your current age for the policy, but you get to keep that rating. And I'm thinking right now of an example. One of our clients, her husband bought whole life. She bought term insurance. And then a few years later, she had a kidney condition. It ended up with surgery, and she wouldn't get that same good rating that she got back then. But anytime in the future, they can convert her term to whole life insurance, and she gets to keep that same good rating.
I'm thinking of a client right now that bought life insurance long before we were ever in the life insurance business. And as a child can't have term insurance on them. And so his parents purchased a guaranteed option to purchase more life insurance in the policy that they bought on him at certain times throughout his life. As this client became older, he developed a condition that he is uninsurable. But because of that guaranteed insurance rider on his policy that his parents put on there, he's able to add more insurance to his banking policies as he goes along.
When we get back from the break, we're going to talk about how to perpetuate the infinite banking concept to the next generation. I'll tell you about what my parents did for me and how that's worked out.
If you haven't subscribed to the Wealth Talks podcast, you can subscribe for free. Just go to Wealth Talks podcast on YouTube and click subscribe. Not only will you get the weekly episodes, you'll get special clips with valuable nuggets of information you can use to win your financial game. Make sure you subscribe.
When our family first got started with the infinite banking concept, Mom and Dad purchased policies on themselves, as they should. That's where they should start. And then they also purchased policies for my siblings and I. Along the way, they purchased multiple policies as cash flow would allow. One of those policies I was looking at just the other day, I paid the annual premium of $687, and the cash value grew by $823. That's like a 19, almost 20% return just by paying the premium. The premium size is not what's important here. It's the percentage that the policy grew, 19 to 20%. That's a great return for me. Now, there were a few things that Mom and Dad had to get in order to make this transition successful. They funded the premium over the years, and then they borrowed out the money that they had paid in premiums and gifted the policy to me when I could afford to take it over and when I had shown that I was financially responsible. So there were things that they did along the way to make that a reality. They taught me to work. They taught me to save. They taught me to value the strategy that they had put in place with the policies so that I would understand and be ready to step into that position when the time came to take over the policy.
One of the things that we worked on, Michelle, with our children was to make sure that they realized that money wasn't wealth. I mean, it's part of wealth. It's a reflection of the way you do it. And I think as we read through Proverbs and the scripture on a daily basis, sometimes more than once a day with our kids, we emphasize the points that what really makes us wealthy is making sure that we put other people first, and that we honor our Creator in whatever we do. And when we realize that our money management is really the stewardship that He has given us, and that in the Scripture it tells us, that if we're faithful over little things, He'll make us faithful over larger things. Jesus talked about two stories, the story of the talents and the story of the minas, specifically dealing with that. And then when we reflected on the story Jesus told about the man who's going to tear down his barns and build bigger ones so he can retire in comfort and live happily ever after, and found out that he was a fool, those are the types of things that help people realize, hopefully, that money isn't going to buy you happiness and everything you need in life.
And by the way, I just have to say that was the kids' favorite passage to write about and illustrate when they were little, when the guy's going to tear down his barns and build bigger barns, and they love to make the barn and then color the fire on there. That was one of their favorite passages to do. But the Scripture does tell us in the Old Testament, God tells parents to train up their children, to teach them, and to teach them when they rise up and when they go to bed and when they walk along the way. In other words, it's parents' responsibility to teach their children. We want to teach them how to think. We want to teach them, all throughout our day, whatever we're doing, they should be near us learning about what we're doing. And that doesn't mean they don't have time to play because, I remember when John, you were little tiny and it was time to clean the bathroom. You'd be so excited. You go in, you'd rip the towels off the towel racks and take out the rug. And while I'm cleaning, sometimes he'd get in there and help clean, but then out came the trucks to drive across the rug that's in the hallway. So he was with me.
Steward helping with the handling of your finances.
And Tom, you were talking about the Proverbs that we would read, and this little card game, Wise Man, Foolish Man, very similar to Fish, but they could play this. It talked about there's different cards for the wise men, different cards for the foolish men, the scriptures that go with it, pictures that go with it, and those are just key references that they think about then as they go about their day and as they meet people, they're reminded of these characters. And then also we read books to them. Richest Man in Babylon is a book that we read. And this is on tape. And some people will just put the tape in and let the kids go do it themselves. But just listening to the tape is not the same as stopping the tape and talking about it and being able to be driving in the car and referencing the story again when it comes up in, whatever circumstances you're in. So a hands-off approach of just giving the book or having them listen doesn't teach them. You want to be involved in the discussions.
I've taken some teens through the book and we stop and discuss it. It's a little bit of a mindset shift as they start thinking in analogies and drawing the points from the story. And that's not something you get just by reading it or listening to it passively. It's an active discussion in order to get those value points from it.
And you were talking to me about working with these teens and having them read the book. And you said at first when you came back together to discuss a chapter, there was no discussion.
It was just
because
relating
they didn't,
the story.
Yeah, yes. They didn't know what to think about it and how to discuss it. And so after you talked about the first chapter together and what that meant, and then it came time for the second chapter, and they're again telling you the story, you're again talking about the meaning of that story. And you said they're starting to catch on now.
Yes.
That it's more than a story. It's a discussion with it.
The infinite banking concept really is a process, not a product. We use a product. We use participating whole life insurance, but we also use the ability to think. And I remember Nelson Nash talking about this at his seminars. It's the way we think about things that changes the outcome of what we're doing. If we just think of the life insurance as a life insurance policy, a product that we can buy and think it's going to make everything happy and glorious by just funding this, well, that's only part of it. We have to think about how to become a banker with those cash values so that we can multiply it and grow it. And, Zig Ziglar used to say he spoke at the 8th grade level so even the academics could understand him. And Jesus talked in stories that children could understand. And this book, The Richest Man in Babylon, talks in stories that even children can understand. And sometimes we just get too sophisticated about wanting to know, all these mathematical terms, and those are important. But if we don't have the basics, then we're going to go the wrong way.
Another book, Grandma's Coffee Can, tells the story that you write about in Prescription for Wealth. It's about his great-grandmother who had a coffee can. She bought premium coffee, and the neighbor would come and borrow it and return it with inferior coffee beans when she would return it. She didn't always return it, but that's a great story to talk about the principles of the infinite banking concept, where you borrow money, but then you repay it because it's valuable, and then it will be there for you. This is a great story. Again, not a book you just buy for your kids and have them read it, although they could read it. But if you really want them to understand the principles, then you have a discussion. And this book also has questions in the back that you can be asking your child if you're not thinking of those questions initially yourself. We also have Winning Your Financial Game. Tom wrote the book. This is a study guide that goes with the book. This is great for young teens. Have them go through the book and study book, and there's exercises in here. But don't just expect them to do it all alone. Come back and have discussion. Or maybe it's a book that you go through together. How, parents ask us all the time, how do you teach kids about money? Well, we can show you how you can teach your kids about money, but don't expect just to give them these products and have them figure it out.
The second law of thermodynamics says that things will go to their most chaotic state without energy put into it. And I go to the grocery store, or we're shopping around and we see kids in the basket just watching and glued to their iPhone. They are missing out on everything that's going around them. They are glued to that little screen, and they're setting their child up for total chaos in their life. I remember you taking our children to the grocery store, and one of them would be holding the cart, the other one would be pushing the cart, the other one would be in the basket. And they were interacting, and they'd get up to the checkout, and they were trying to bag all the groceries because they were just all involved in what they were doing. And children that are not given the opportunity to do that are not going to be able to adjust to life because they're used to being programmed by some outside influence.
Well, even before we got to the checkout counter, they would be in the aisles with me, and I would ask them, would you get a can of tomatoes or whatever it was? And they knew which brands we got. But sometimes as they got older, they go, Mom, why don't we get these tomatoes? So then I had the opportunity to show pricing. And we could do the math to figure out, oh, okay, that's why we're getting these. And then as they went on, they would say, oh, Mama, look, these olives are less expensive. So then I would say, yes, they are, but we prefer the other olives because of their taste. So it wasn't always about the cost. It could also be about the quality. And we had the opportunity to discuss that, to look at it. And maybe sometimes we might buy the inferior product, get it home, and let them taste why I had chosen the more costly product.
Those are things that sometimes we take for granted, but those life lessons are so important because they can translate and they will help, as children start their own lives.
So, John, you talked about how we transferred your policy to you when you became an adult and responsible and capable of managing it. It's a real simple process, and we help people do that frequently as their children become adults and responsible. The key in us taking the money out of your policy, the cash value out that we paid for it, is to prevent there from being a tax liability, because the IRS limits how much can be gifted to somebody in any one year. And so by taking that money out that we paid for it, we eliminate that tax liability.
A parent now could gift some of that money back if they want to do so. So there's no set rules about how you have to do this. Like Nelson Nash said, he quoted Albert Einstein, imagination is more important than knowledge.
The wonderful thing about a family understanding and participating in the infinite banking concept is that more of the wealth that they generate will stay with the family for generations to come. Nelson Nash, who wrote the book about becoming your own banker, understanding the infinite banking concept, realized that wealth was being transferred in our society from the middle class to the upper class, to the banks, to the financial institutions. That's why he was so passionate about getting the message about keeping money in the family. He used to say frequently, wealth has to reside someplace. It might as well reside with you and your family for generations to come.
If you want more wealth to reside with you and your family, expanding your infinite banking policies is a great way to make that happen.
If you have any questions about how you, specifically, can use the infinite banking concept in your situation, I suggest giving us a call. We have been using the infinite banking concept for over 17 years. We know how to use it, we know how to get the benefits of the infinite banking concept, and we know how to help you do the same. With the new year just getting underway, now is a great time to get started on the right track with the infinite banking concept in 2025.